Good morning and welcome to our webinar today, which is, as the title slide suggests, all about cash flow management. I'm delighted to be joined by Neil Driver, partner here at Davis Grant, who's going to take us through everything we need to know about cash flow management. If you do have questions for Neil as we go along, the chat option is working. You can leave questions there as we go, but ideally use the Q&A and we'll try and get to them at the end. So over to you, please, Neil. Thank you.
Thank you, Jo, and good morning, everybody. I thought that an important part of cash flow is our own personal cash flow, and seeing as we're so close to the budget that the mini budget that just took place, I'd spend a few minutes going through that, which hopefully is of value to you. Just to run through the key elements of what was put out there. It was quite publicised in the press and all the knock-on effects, but from a tax point of view, there were some big things in there: reversing the 1.25% national insurance rate rise, including the dividend tax rise, reducing the basic rate income tax from next year, not putting up corporation tax, giving further investment allowances, which is to do with buying plant and machinery in the way you get tax relief in a company, appealing what's called IR35 and off payroll reforms. I'll just touch on that as well, and changes to SDLT, stamp duty, or tax you pay on purchasing properties. Cracking through that, the 1.25% national insurance rise, which was for individuals and employers, is going to be stopped as from 6th of November. So next month, October, will be the last month with that in. Everything changes from 6th of November. Now, it's a huge challenge for software suppliers to make that change by then, and I hope it comes through. If not, it'll get quite messy, but certainly that's coming through. It's supposed to save £330 a year on average, and that would be the employee saving if you follow that through for a company per employee. So that does add up to quite a bit. That is being reflected in the dividend tax rise, but is not from October. It's from 5th of April 2023. I'll come on to some tax planning points when I've just been through all the numbers. And so the £2,000 tax-free dividend allowance still stays. As far as income tax is concerned, the 1% cut is coming in from the beginning of next year, from 20% to 19%. And the headline grabber on top of everything was getting rid of the 45% tax band for earners over 150,000. They have not got rid of the reduction in the tax-free personal allowances when your earnings are over 100,000, so that nasty bracket still stands. For corporation tax, there was a planned increase from 19% to 25% from the beginning of next April. That has now been taken away, so the 19% rate just carries through unchanged. When businesses purchase capital machinery or invest in assets, there is an allowance that allows them to write off up to £1 million of that investment, get 100% tax allowance on that in the year that you make the investment. That had been increased from 200,000 up to £1 million, and that was due to stop at the end of next March. Now that is carrying on at the £1 million level permanently now, which I think is very good news. The 200 level was really quite low. So that gives better tax allowances for businesses investing going forward. There's been a repeal to IR35 changes. Now, those changes really relate to individuals who are supposedly self-employed, acting through limited companies. like personal service companies. There was huge headline things for people in the BBC and maybe even in the civil service billing for their services through their own limited company rather than going on the payroll. Now, there's history for this. Are you employed, self-employed, and can you put a limited company wrapper around that to shield the tax incidents? And what was done was previously the tax burden for getting it wrong remained in the small limited company, the individual's limited company. What the government had done over the past several years was to change that obligation and change who paid the tax if it should have been on the payroll rather than the limited company, and change that burden to the organization who was ultimately using the individual. And that would relate it if you're going through an agency, if you had an umbrella company, all kinds of things. Change the emphasis from the individual company to the employer. That had fallen down from originally it was just government departments and the health service, then it was large companies, then it was medium companies. So only small companies were left not to be affected. Now, there's a huge amount of red tape, massive disruption. It did increase the tax take, which is another issue the government have got to deal with, but that has now changed. So on the face of it, it's a nothing, but really it's quite significant for contractors and subcontractors and the way the whole of that side of the industry worked. It will probably cause things to flow back to more revenue inquiries because they need to clamp down through other ways, but that massive bit of red tape's been taken away. Change to SDLT. They've lowered the threshold, particularly for first-time buyers and other buyers. So it's far more efficient to you can buy a more expensive property without paying stamp duty. Now those thresholds have flowed through to buy-to-let landlords and people with more than one home, but the 3% additional tax still is on top, but it's just in the revised bands. So what does that mean really for some very initial thoughts on some tax planning? Well, obviously, if you're an owner-manager of a business or you take your remuneration through dividends, think about deferring those until 2023. That's going to give you 1.25% plus 1%, so 2.25% less tax that year after April than now. It's not always possible to do that, but it's worth thinking of. But beware of, if you do defer income, pushing yourself into different marginal tax bands. So that's around £50,000 is the first one, where you change from 20 to 40%. And as I mentioned before, there's a very nasty band with over 100,000 when you lose your tax-free allowances. That's still in place. So it's worth having a look at and taking time to look at those possibilities. If you're clients of ours, then we'll be doing that by default. But speak to us if you're not and you need advice, or you need to speak to someone, speak to me or anybody in our tax team at Davis Grant. For businesses, I think that's the changes to investment allowance and corporation tax allows a lot smoother profit transition. We don't have to plan for perhaps bringing profits in earlier if possible for the lower rates of tax, and also you can smooth investments over time. You don't have to look at cash flow effects of taking the most advantage of the annual allowance before it was lost. So I think that's a good thing. Loads of news about that in the government, but in the context of today's thing on cash flow, which I'm coming through to now, the whole effect of the cash flow on the government is ultimate, and also it's the cash flow effect on individuals to increase their what's in their pocket at the end of the day. So with cash flow in mind, just wanted to kick off with a thought for today's session, which is one of the earliest lessons learned for me and others in business is that balance sheets and income statements, you can say, are fiction. What really, really matters is cash flow. Now that I find across the board is how it is with most clients, and personally as well. Today, I would like you to grab a pen and paper. If you don't have that to hand, whilst I'm just running through the first bits, please grab something, because I would like today to be a bit more interactive, even though it's online. There is going to be some thinking time and writing down time. So please be prepared for that as we go through. So today's session is really about challenging you to become aware of your cash flow cycles in your business and to do something about it. I don't really want you leaving today's session without having an action plan for doing something new or different going forward. So we're going to be looking at 5 principles for keeping the cash flowing. Cash is the lifeblood of any business. And without that, we can't survive, obviously. And even very profitable businesses can fail because of poor cash flow. When business is growing fast, often, and with startups, you need working capital to fund that growth. That's why it's called working capital, because it has to work hard. The business has got to pay for stock, payroll, overheads, costs, and there's a whole cycle of that before it comes back in. So the fact that the business is making profit or is selling goods and services at a good margin doesn't necessarily mean that the cash flow is coming through and it can be tight. And I'm going to try and explain more about that today. So we'll be looking at symptoms, we'll be looking at underlying causes, and hopefully preparing you to make some changes that are going to have a positive effect in your business. So the agenda for today, I'll be looking at these main points as we go through. So we're going to look at the difference between profit and cash. We're going to be looking at the working capital cycle, cash conversion, and trying to put together a plan for your own cash improvement, cash flow improvement. And then I'm going to run through the 7 causes of poor cash flow. And that's when you're going to really need to have some pen and paper ready, because I'm going to leave within each section, I'm going to leave a bit of thinking time for you to note things down. And within that, when I give you some thinking time, I'm going to try and ask you to put some notes on the question and answers so I can see what you're thinking, and we'll see how that goes. Hopefully it works as we go through. Next steps will be at the end, and then question and answers if there are any at that time. But one of the biggest problems we have is FTI, or failure to implement. Find that over and over again. I'm sure, like me, you've been to various webinars, seminars, have lots of ideas, write them down or don't write them down, get back to work. The day gets away with you, and we fail to implement what we've actually listened to and learned and decided to do. The most successful businesses I find are those that do implement things, even if it's 1 or 2 things. It's really important to do. So let's try and not fall into that today. So first thing is profit. Profit and cash aren't the same. If I was in a room, I'd ask for a show of hands as to who actually reads the financial statements their accountant shows to them. For me, I know that some clients do, and some clients understand them, and others, it just washes over them. It doesn't really seem to relate to now. They're historic and they're the past. What really matters is what's happening today. And people tend to associate with what's in their bank account very much, which I fully understand. I do too. So it's not surprising there's a confusion sometimes between profit and cash. The profit is the money that's left once everything is paid from the turnover that you create. And some business owners think that profit should flow through to the bank. Well, if only it doesn't work that way. Profit's got to be used to pay for equipment and for stock and materials and so on. And of course, tax. So only after paying all those elements that effectively are going to grow the business or repay elements that the business has had to finance itself or tax, is what's left in the bank. It sounds obvious, but there is this disassociation between, oh, well, I've got a profitable business, but there's nothing in the bank. And just trying to illustrate a few things as to what they are. Here are just a few elements that you'll see that go in and out of your bank account, possibly, and just illustrating what the difference is between profit and cash. So on quite a simple basis, VAT, well, VAT only affects cash. Of course, it goes on invoices in and out, but the true cost of the business is the net before VAT rather than the VAT inclusive amount. We are just all unpaid tax collectors for the government, and so the VAT is not ours. It's purely cash in and cash out. Can have massive effects on people's and businesses' cash flows, it can be quite significant. Loan repayments. Now, loan repayments are the capital side of loan. It's got nothing to do with profit. So if you borrowed £100,000 or £10,000, whatever it is, from the bank, that money comes in. That's not income. It's just borrowings. It's just a difference between what's in the bank account and a creditor you owe money back out to. And so the repayments of that are not a cost. They're just purely cash flow going out. The interest on a loan, however, is both. The interest is a cost to the company, and of course it goes out in the bank account. When you buy an asset, that asset cost, if you're buying a new car or some new machinery, or you're investing in a large asset, that is cash going out of the bank account, but is not a direct expenditure. What is the expenditure is what's on the bottom line, which is depreciation, and that's just basically recognizing the cost of that asset over its useful life. But depreciation isn't cash. What is cash is paying for the asset in the first place. And similarly, when you sell something, an asset, that is just cash without any profit. So there's a few indicators of things that people get mixed up with somehow. However, cash is what does affect cash is, of course, how quickly money comes in from our customers and how long it takes us to pay our suppliers. They're usually the largest movers of money through a business, and I'll look at those in more depth. And that depends on how long it takes for both parts of the cycle. And we call that the working capital cycle. Just to illustrate it here, on a very, very simple basis, if you don't have any suppliers or if you don't have any staff, simply you've got sales coming across to be received, money coming in, and a circular little pattern through there. But if you're a manufacturer, or if you've got a team of people working for you, you can substitute people for purchasing stock. You've got a different, more complicated cycle. So normally, starting at the top or just towards the right, you purchase something, you employ someone, and then you have to pay them. That payment gets converted into stock or work in progress or an item before you can sell it. You then sell that item. You then got to receive the money in, and the cash comes in. So that is really an illustration of the working capital cycle, and those all take time. And it depends on the type of business, how long it takes to convert whatever it is you make or the service you provide into cash. And to understand the cash flow effect on your business, you can then calculate your own cash conversion cycle. And let me show you what I mean by that. So let's take, for example, a real example of a wholesaler. That wholesaler buys stock from suppliers and has got, for example, until the 20th of the following month to pay for that. And that will average out peculiarly to, say, 35 days. So on average, he's got to pay his suppliers 35 days after he buys the stock. Of course, you can't sell the stock the moment it comes into the warehouse. Some sells quickly, others takes longer. And eventually some stock might have to be discounted or even written off if it wasn't a great idea in the first place. And let's say on average, that stock from the time it comes through the door to on average when it goes out is held for 65 days, a couple of months. I think that's fairly reasonable. So when you sell the stock, you then provide credit to customers, but that might be 30 days, for example, but we all know that customers don't always stick to that. And let's say on average, it takes 45 days for the customers to pay. So if we put all those factors into a cycle, we can then calculate the cash conversion. And this works out to 65 days average stock holding and 45 days to get paid by customers. And then you take off the 35 days credit that you get from suppliers and add the two first things, take off the 70, the last one, and that gives 75 days to convert inputs into cash. So you can do a similar thing with a service provider and substitute your payroll for stock. Payroll, actually, there's no credit for payroll. You've got to pay your staff, your team at the end of the month or the end of the week, and that then causes a tighter cash flow cycle because you can't defer anything, and it may well take you time to produce what it is that you sell. For us, our cycle of how long it takes to produce a tax return or some advice or a set of accounts from beginning to end, that's a period of time that we're always looking at to try and keep down as much as possible, because that's effectively our stock holding. It's our work in progress, and that's the same for any service provider. So that is an exercise to think about, and hopefully this illustrates that quite simply for you. Hopefully it's obvious that the shorter the cash conversion cycle, then the better the liquidity that you've got, more cash and more room that you have in your business. So if you're a manufacturer, a wholesaler, or a retailer, or a service provider, you'll need to calculate your cycle. You'll need to know how long it takes you in average to pay a supplier, how long you're holding stock for, and how long your debtor days are. If you're a service provider, you've got to know your supplier payment terms, that still comes into it, and your average work in progress days. That's the figure I was talking about. Service providers will understand that, and your average debtor days. I'm not going to get too technical here. We can help with this if you want. But what you've got to do, I want to get across, is that you need to know these to work things out and appreciate how your business works. The impact on cash flow of shortening your cycle can be incredible. So here, there's an example of a manufacturer, initially with goods sold at 76 days, with a cash conversion cycle of 76 days rather. But if we focus on renewing a few, reducing rather than renewing something like debtor days or how long they hold stock for, then it can significantly change the cycle. And on this kind of profile, where you've got these numbers that support a business of about 1.5 million, making a pretty average margin and overheads, that's quite a normal profile. If you work those two improvements through, debtor days reducing and stock holding reducing, this company can save £50,000 a year, £52,000 a year, which is really significant if you can knock that off your overdraft or reduce the stress on the company. So those are the sorts of numbers that we can help run through with you to see the impact on your business of shortening your cash cycle. But you can't just realize that extra cash without doing something differently. So to achieve it, you really do need to have a cash improvement plan. So a cash improvement plan is really suggesting that you should have the following. You've got to have a cash flow forecast. I think that's pretty obvious, and something's got to be done from day one. You need to incorporate into your cash flow forecast into your accounting software if you can, so you can get up-to-date real figures of actual to budget. Set a plan of how to make your improvements and have SMART goals, measurable, realistic, achievable goals. And often with these kind of things, as with any plan, if you've got someone independent to hold you accountable, then you're really going to implement it and you're going to be working at things a lot easier. I know someone looking over my shoulder every quarter or every month, holding me to account to do stuff does make a difference. Without that, things tend to drift. I don't know who has a business coach or who has a mentor, but if you don't, you should really think about getting one in place, because they can be really significant as to how the business performs. So now this is where you need your piece of paper, or need to have that already. It's going to go through these different parts of the reasons for poor cash flow. Poor accounts receivable, resulting in the time between when you bill and when you get the money in is going to be too long. You need to look at suppliers, review your payment terms, see if you can get longer terms of trade with them. Just having stock too long may be full shelves, but can lead to an empty bank account. And there's no difference between a service provider being work in progress and me talking about stock, as I've said. Perhaps your debt capital structure needs to be looked at. You might be repaying loans too quickly, or you might have the wrong kind of interest rates. You might need more finance to make the wheels turn smoother. That needs to be looked at. You've got to look at your overheads, review them thoroughly. And your margins, obviously hugely significant. Are they too high or are they too low? There's a large number of strategies that you can implement to improve margins. And finally, volume. Sales just being too low to support the overheads and other cash demands on the business. It comes down to how viable the business is right now. Even if it's in high growth and sales are increasing rapidly, business needs finance to support that. If it isn't in growth mode, it needs to focus on how sales are growing. So let's look at some of the strategies we can put in place for each of those 7 areas. And as I said, I want you to get involved here. And if you can feed back to me some ideas through the question and answers thing, just note things down and feed them through. That would really be helpful, and we can get some interaction going here. So the first one is accounts receivable. So what I'd like you to do is to think about put down a number as to what you think your accounts receivable timescale is. Is it 45 days? Is it 60 days? What is the difference? And the way that we'd calculate that is to say what your kind of debtors are now compared to your total turnover. How many months turnover are you owed by your customers? And then think about, and I'm going to stop talking for a few seconds while you write this down, how you can improve your accounts receivable process. That's really as simple as it is. So I'm going to keep quiet for a minute or two, well, for a few seconds anyway, and I'd like you to write down the things you can do to improve your accounts receivable process. I will kick off by perhaps helping you on one thing, and that is reviewing your terms of trade. How clear is it to your customers how long they've got to pay you, and how well is that documented between you and your customers, so that if you chase them for being late, there's no dispute as to how quickly they should be paying you. Another one could be perhaps how could you improve the way you get your money in by offering a discount for prompt payment. That's another way of improving accounts receivable process. Another one might well be billing faster. How do you bill on completion? Do you bill at the earliest opportunity, or do you wait till the end of the month? What is your billing cycle? The quicker you bill, the quicker the money comes in. I've seen all kinds of examples of businesses with projects not billing quick enough, and so on. Or you could even consider interim billing. Make sure that you've got as many easy ways for people to pay as possible now. You can have links to payment by card. You can have many different ways of online payments, and direct debits, credit cards. If you don't take all of those, think about how you should put them in. It's very easy nowadays. And if you want some advice on online apps and so on, we use them ourselves, and we advise clients what might fit for their business the best. What debtor control process do you have? How do you send out your statements and your chasing process? How good is that? What can you do to improve it? You can, if you're using Xero, there's add-ons within that software to chase easily, and so on. And those are a few items on this accounts receivable process. I hope you're writing down what is applicable to you. The next one is going to be looking at accounts payable. So it's kind of the reverse of what we were looking at on money coming in. It's going to be looking at the same thing for money coming out. Are you taking maximum credit from your suppliers so that you don't incur late payment penalties, but you're paying them at the timescale that suits you? Alternatively, if you have cash in the bank, you've got to look at any prompt payment discounts that are available to you, because that can cut your ultimate cost, and you may well be able to reduce costs overall. Look at your supplier agreements, payment terms, and see if you can renegotiate the length of time that you've got with them, and the overall payment process. And if you can, it's a bit of a stretch for some, start to put budgets in place. If you put budgets per supplier, that might stop people in larger organizations incurring costs that aren't necessary, and so on. But really have a look at that from the supplier side of things. The next thing in our Magic 7 is your stock and work in progress levels. In what way can we shorten the cash cycle by moving this stock faster, by moving the boxes or by moving the service faster? That is going to apply to pretty much every business, as did the others. So look at, if you're moving boxes or buying stock, look at your stock ordering systems. Try and make them as lean as possible and try and cut down the time scale. Obviously, now businesses are impacted after Brexit, and with COVID, the lead time for purchasing and stock coming through is much longer than before, and that can actually have quite a negative impact on cash flow, especially if you're having to make pro forma payments or payments on account or payment on order. So this can be more important, how to keep that timescale as short as possible. Look at technology to see how you can manage stock reordering and triggering stock, making sure you keep track of stock levels and using software to calculate stock levels, lead time, and when you can be ordering from suppliers. Check your slow moving stock and what you do with it. What do you do with stock that's been sitting on the shelf, or work that hasn't been billed that is just stuck? I mean, that's a huge amount of cash for a lot of businesses, just sits there. And find that businesses don't necessarily want to take a loss, but if you consider it to be freeing up cash that can then be used to make a profit, it's a slightly different mindset. And if you're getting rid of stock pretty much close to cost, you're getting rid of that issue, you're freeing up the cash and you're moving on. If it just sits there, it's going to end up costing you money. So put in policies to look at slow moving stock. If shrinkage is an issue for you, that can be for some businesses, what do you do to keep that to a minimum? And overall stock control processes, document that and communicate that to your team. So again, please make sure you're writing down within your cash flow issues what you can do about your stock system, turnaround time and control. All of these things add up to significant changes, even if they're small elements, and each one can make a big difference overall. So your debt capital structure, not applicable to everybody, but I'm thinking as time progresses, the way the economy is now, what might be on the horizon over this winter, it's likely that businesses are going to need to borrow more, even with increasing interest rates. So it's very important to get this right. Check the interest rates that you're paying, fixed against variable. Is the loan that you've got right? Is it right for the business? Are you financing your business with overdrafts when you can be financing it with more longer term funding? The banks and institutions like to make sure they've got the right funding for the right purpose, and it is not too difficult to switch from the wrong type of financing. It's just important to look at it. Look at your drawings, for example, how individuals are you're taking money out of the company. That can have a big effect and might need a change in how it's financed. And in terms of with debt and capital, it's how the business is financed. You might need to raise capital from new owners. You might need to raise capital from somewhere else, apart from banks. And look at all of the areas that might be applicable for you in your business. Just make sure you don't leave this out when you look at cash flow. Cash flow is not just about operational side, it's more about strategic and longer term issues as well. Where are we up to? Number five, overheads. Overheads, everybody needs to keep an eye on those. I think most people have a look periodically, but make sure you get into an annual review and just have a deep dig down to make sure that you are not overspending on things, and do go out in the market to compare. Obviously, everybody's looking at their utility bills at the moment, light and heat and so on. but check out staff expense claims and get budgets in place for all your overheads. Look at what's happened in the previous year. Have a deep dive into your nominal ledgers, see what's going on. Most businesses tend to find things that they didn't realize that have been dragging on for years, things that they thought would finish but haven't, and just a better realization of what is going on. Number 6, gross profit margins are too low. So gross profit is what's left from sales value after you deduct all the costs for stock and resale. Really increasing margins is huge. Of course, don't underestimate, and I don't underestimate market pressures for keeping margins where they are, but I think most people recognize price uplifts are coming through all over the place from everybody at the moment. Inflation is going up, costs are going up, the pound is going down. All those effects have to flow through. None of us want to be ahead of the market, but we've got to keep up with it, and don't be afraid of pushing up your prices when you need to. But within gross profit, there's other things, reducing waste, improving your systems, capturing and billing time better, costs better, and talking to suppliers, looking at your discounts again, see if you can get any prompt payment or just cut costs from suppliers. All these elements, looking at your gross profit margin. I think business owners do that instinctively, but this is one of the areas that really you can drill down into quite a lot, all of the component parts of what goes to make up the cost of what you sell, and start to see how you can improve each one. So for your business, think about the areas that break down within your what goes up to cost what you sell, and think about the areas that can be improved. The last number are sales are too low. Now that's a very personal thing per business. Some businesses are cracking away, others are not. But of course, cash flow is going to improve the more you sell. And you could spend weeks talking about sales and marketing all in itself, of course. But think about simple, quick wins, and those can be increasing your customer retention rates, how to get more leads, how to convert those leads better, and how to increase, for example, how often people buy from you, and then look at how much they spend with you. Those 5 little elements, I don't have time to explore them all now, but each of those are elements of what can make up your sales side, and increase how you sell, increase the numbers. I'm aware we are kind of quickly running out of time, and so I will run through how we can help you. And there's three elements there. We can sit down with you for a profit and cash flow and profit improvement meeting for 90 minutes or so, and that will need an investment from you of £300. Putting together a cash flow forecast is quite dependent upon the size of the business, but we'd sit down and review it with you and explain it, and then revise to anything that you needed for a final revision. This should be done for the business, irrespective if you want to put it together for the bank. You can't really consider what's happening, and in the next year or so, I think looking forward is even more important for you to realize what's going to happen. And that is a price range depending on how complex it is. And if you want monthly rhythm or quarterly rhythm either, we can sit down and design a specific program for you, and that's priced from $390 a month. If you want quarterly, then we can facilitate that too. The next steps leading from today are really, you've got 4 possible courses of action. You can do nothing, which I don't think is great. You can say, oh, it sounded a bit scary, but I'll go away and hide and do nothing. You can take your normal amount of action. I think I need a cash flow forecast and need to look at this. but I'll probably do it myself. And that most likely leads you to doing nothing or retreating, or you can take massive amounts of action. And that usually needs taking some help, getting some help. And obviously, I don't advocate doing nothing. And I think you really do need to do something. I'm not just stressing this to try and generate business for us. The important thing is that you understand what's happening with your cash flow nowadays. And you do have to do something about it. And that's what I'm trying to stress. Hopefully you've got things written down. If you have any questions, please put things down for me. I don't have any questions and we are running out of time. There you will receive slides afterwards, and you do have our contact details. I'll put them up at the end. Please don't hesitate to contact me if you need to. I will leave you with a parting thought though, and that is the 3 most dreaded words in the English language, according to someone called David Tang, are negative cash flow. I don't like the sound of that, never have done, never will do, but hopefully after attending today's webinar, these are words you will never have to hear or deal with again. Now, wouldn't that be great? If we can help you with that, that would be good as well. So if you need any more help, we're here for you. Here's our contact details. And I would like to thank everybody for joining, and I look forward to hearing from you or seeing you at another webinar. Please do send through your questions, give me a call, and be happy to help you.